Hey everybody, this is Anthony Accurso, live from my basement. Uh, been doing really well, trading some micro and nano-cap stocks, particularly in the biotech and pharma industry, and wanted to share some of the methods and some of the tips. A few times I've posted some recommendations on Facebook and Twitter, and had more people than I thought actually scooped up some shares of some of those stocks and have done really well. And have reached out and said thanks, and I have had a few requests to kind of explain what I'm doing. So, being a former medical student, medical resident, a lot of experience making PowerPoints. Probably made about 100 or 200 in my life. So, figured I'd get it all in PowerPoint form and kind of narrate for you, and then hopefully, if this app works, I show you some of the tools I use that you can get for free with your public library. So, what the whole point of stocks? What are we doing here? We're making an investment, trying to buy a commodity or a piece of a company. Some people buy gold, some people buy oil, some people buy other commodities like cattle, real estate being a major investment. But what we're focusing on here is stocks, which are shares or a small fraction of a company. And the whole point is that your investment is going to grow over time, and that it's going to grow fast. How do we judge the success or lack of success of an investment? And kind of the gold standard in terms of stocks is the S&P 500. So if you're ever watching the news and you see at the bottom of the screen, you'll see what's the Nasdaq done today, what's the S&P 500 today. So what is the S&P 500? The S&P 500 is actually an index of 500 of the very largest companies that are publicly traded, and the biggest companies have a higher weight of these 500 than the smallest companies in this 500. So if you buy an index of the S&P 500, what you're really buying is a weighted index of stock in 500 of the biggest companies that are publicly traded. And if you put your money into something like Edward Jones or some other managed investment firm, what they're going to do is they're going to index your money into funds, and most of them are going to choose companies in the S&P 500. So just a standard index of the S&P 500, 26% of that is actually driven by the 10 biggest companies. So you're talking about companies like Apple, Google, Microsoft, Facebook, Amazon, Tesla. And if you're investing on your own, uh, this is the standard to which you're going to measure your success. So, again, if you put your money into something like Edward Jones, I keep using them for an example because my wife and I rolled some retirement accounts from previous jobs into Edward Jones, and we have some investments with Edward Jones. They're going to be investing your company into these big companies generally. Sorry, they're going to be investing your money into these big companies generally. And the number of investors expressed as a percent that can actually do better than the S&P 500 historically is about 15 to 25%. And I think this is a big reason for this is that people don't have good guidance on what to do and how to do it. And there's also, I think, a lot of fear and fear of loss and fear of the unknown and not knowing how to do it. So, for anybody out there that's kind of looking for a little bit of a tutorial into how to get started, that's the whole point of this presentation. So if you look on the right of this slide, you'll see on a year-by-year basis what has the S&P 500 as an investment return. So 2012, 13%, 2013, 29.6%, in 2015 and 2018, the S&P 500 actually, your investment would have lost money. In 2020, the S&P 500 returned 16.26%. And these really aren't that impressive numbers if you really look at the numbers on the right of your screen. It's not really that hard, to beat 13 to 30%. It really isn't. And again, hopefully this presentation will show you a couple of reasons why um, I've found some great success in some of the companies I've invested at, and help you uh, find some companies on your own that I think have an excellent chance of beating the returns you'll get with an S&P 500 index fund. Um, it's also probably important to say companies, again, such as Edward Jones, they have funds that are uh, pretty much an S&P 500 fund, but they might do a little extra research and they might pick certain companies that they want to weight more heavily, or some companies that they don't want to include in their index fund. So, for example, Kelsey and I have a little money in an account called Guided Solutions through Edward Jones, and they weighed certain companies a little bit different than the standard S&P 500 index, and they were able to beat the S&P 500 modestly. When I say modestly, again, we're talking about the S&P 500 returned 16.26% last year. So that means if you put $1 in an S&P 500 index fund, you would have turned that into $1.16.26. So we're not talking about astronomical returns. It's a very conservative metric by which to uh, judge your investments, and it really isn't that hard to beat. A few terms here that I think will help some people understand some of the basics of stocks and how to trade them. So you'll often see the term, as you research stocks, market capitalization or market cap. And what is that? Essentially, market cap is what the company is worth uh, according to the stock market. So that number is a multiple of the number of shares that exist of the stock for public trading multiplied by the price per share. So if a company has 1,000,000 shares and its stock is $1 per share, the market cap is $1,000,000. That's a $1,000,000 company. Um, and it's important to know this because a lot of people don't look much further than what is the price per share, and hoping that that price goes up, but not really understanding what goes into that price. So market cap is the value of the company as dictated by the number of shares in existence for public trading and the price of each of those shares. So this is a screenshot from Yahoo Finance, and this is actually the company Apple. So the market cap for Apple is $2.17 trillion. So ginormous company, and that value of 2.17 trillion comes from the number of shares, again, that are open to trade on the public market, and the price per share, which at the time I made this slide was about $130. Company size says a lot about the potential returns for the investment, and when you're looking at what is the S&P 500 return, really that's only looking at the largest of the large cap stocks. So these are companies that are worth 10 billion or more in value. And again, your Apple, Google, Tesla, Facebook, these are really huge companies. And so the theory, I guess, with historical trading and weighting returns as compared to the S&P 500 is these very, very large companies, they're going to be here forever, and they're going to slowly grow. Sometimes they grow rapidly, but in general, the big companies slowly grow, and they have very little downside. If you're looking at a long-term investment and you're wanting to buy a company like Apple or Google or Facebook, you don't have to worry too much that those companies are going to decrease in value. You can feel very confident that in 10 years you're going to make a lot of money investing in these companies. Um, but uh, they're not the biggest source of gains in the market. So you'll hear me refer to small and micro cap and nano cap stocks, and uh, I focus exclusively into nano and micro cap stocks, and I think everybody should who has uh, any short term tolerance of risk compared to their desire for long term gains. So every company that I, in general, invest in is worth less than $1 billion, and a great majority of them are going to be worth less than 50 million, which is considered nano cap. This is a graph that was showed to me by uh, a professional investor at actually a education session for me uh, and my employer, and it really speaks a lot of volumes. That what this graph is telling you that is that if you put $1 in the stock market in 1925, as of December 31st, 2017, if that dollar was in microcap stocks only, that dollar would have turned into $36,929. Small caps only 23,522. Mid caps 17,358. Large caps 7,338. And it just really baffles me that it's clear that the biggest returns come from this investing in the smaller publicly traded companies, yet the focus nearly universally is buying these big, huge companies, uh, and a lot of that comes from just cultural and individual risk aversion. For anybody that follows me on social media, I have this constant complaining as I watch football games of coaches that will punt the ball on 4th and 1 or fourth and a relatively short distance to go. And the analytics say that going for it on those down and distance drastically increases the chance to win. But the coaches are so risk averse. In other words, they don't tolerate the risk that the other team will stop them and have better field position. So they punt the ball, and by doing so, they're actually drastically decreasing their chance to win the game by punting the ball. And in a lot of ways, I think that's a really good analogy for the attitude people bring to buying stocks. They're so focused on not losing money that they minimize the tremendous potential for gains with the smaller companies that are publicly traded. So here's another graph and showing same story. We're not even talking about micro and nano caps here. Small caps, most every year are outperforming large cap stocks. Sure, in 2014, the small caps had a less return, but over a large period of time, you just see so much more potential for gains and investment by investing in smaller companies. Uh, Again, this is a similar graph. $1 invested from December 31st, 1925 to December 31st, 2019. $1 in the large cap stocks that everybody seems to love and obsess about putting their money into returned $9,000 in 94 years. In microcap stocks, you're returning almost $45,000. So, how do we find value? How do we know what a company is worth versus what the market says that it's worth? There's a company that I really just love to utilize in my valuations, and that is Morningstar. Morningstar is a company that has been around since 1984. So, 84 and 2021, we're talking this company's been around 37 years. check my math on that. But been around a long time and valuing putting valuations on companies to help investors for quite a while. And you can see this is just a screenshot of my Edward Jones account. I mean, they have Morningstar valuations attached right to their website, and Edward Jones puts a um, ton of weight into what Morningstar says. You know, that's um, one of the biggest sources of information that they depend on to help invest your money if you're one of their clients. Um, so you can see right here on the Edward Jones website, they provide links to almost any company that is searchable on their website. They provide a link to the Morningstar valuations. And I've talked to my Edward Jones investor, actually become quite a friend, and you know, he tells me they really put a lot of stock into Morningstar. But one thing Edward Jones doesn't do is put much weight into the micro and nano cap stocks. Only about five. If you give money to Edward Jones to invest, they're only weighting about 5% of that money invested into micro and nano cap stocks. They're investing your money into the very, very large company because it's comfortable, it's conservative, and you know, they will help you not lose, and you'll make a little bit of money, but you're really, really putting a cap on the type of returns you can get. So here's some screenshots, and I just kind of wanted to show you one of the reasons, again, why your growth potential is so limited when you buy these big companies. So we're looking at Apple right here. This is a very recent screenshot of a Morningstar report on Apple, January 8th of 2021. The stock is trading for $132.05. Morningstar thinks it's worth 96 and 17 cents. So what Morningstar is saying is if you're buying a share of Apple today, or on January 8th at least, you're paying 35% more than actually they think that share is worth. So if this company is worth had a market cap of 2.17 trillion, you can remember the previous screenshot. What they're saying is that that's actually a 35% premium or overestimate of what the company's worth. So Morningstar actually thinks that that company's assets, revenue, intellectual property, cash on hand, they think that that is actually worth 1.61 trillion rather than 2.17 trillion. So you're overpaying, in their estimation, 35% when you buy a share. Another big company, Google, it's trading fairly close to what Morningstar thinks the company is worth. Sorry, so if you're paying $1,800 a share for Google, that is similar to what Morningstar uh, values the company at. Here's another company, Tesla. It's making a lot of noise. It's trendy. Everybody wants to buy Tesla. Hilarious valuation here. And Elon Musk has actually said so himself. He thinks this company is overvalued. So the last closing price as of January 8th, 2021 was $880.02. Morningstar thinks the company is worth $373 a share. So they think you're paying 135% more than the company's worth per share. And keep this in mind when I show you some of the investment choices I like to make. So now that we're done with the PowerPoint I've made, I'm going to pull up a resource that I think people will find very useful, and a lot of people do not know is free from their public library. I actually have made a link on my desktop here at the Johnson County Public Library, and our username and password is stored. But you can find Morningstar Premium in general if your public library has an online aspect to it. And this is this is an expensive tool actually that's made free to you through your public library. So my favorite place I like to go is the screen for stocks feature. So we're going to click here. And it's a beautiful filtering tool. If you click View All Data here, they give you just a humongous amount of data that you can sort your stocks by. So I like to apply a series of filters. And the first one I like to apply is just let's get rid of these big overvalued companies that are extremely conservative and provide little potential for return, relatively speaking. So I'm going to put market capitalization, and this is in millions, so 1,000 million is a billion. Again, check my math on that, but um, we're going to apply that filter. So we have 6,662 stocks that are publicly traded worth less than $1 billion. So the next filter I like to apply is stock industry group, and actually, I'm sorry, it's not stock industry group. It is stock sector slash type slash classification. So I like to go to healthcare, and um, if your goal is just to get a good understanding of stocks I like to invest in, that's going to be in healthcare because that's what I know. I've spent since I was 18 years old. I'm 33 now, so 15 years of my life just engulfed in medicine and learning the field of medicine, and now oncology. So I like to really stick to what I know. Uh, and I've had some friends tell me, if they've tried to apply these filters to other, either to real estate or energy or industrials. Um, Lots of different ways you can sort this, but I like to plug in healthcare here. So, and again, that's going to greatly decrease the number of stocks that are showing up in our filters. We're now at healthcare stocks that are worth less than $1 billion. And then the most important, I think, of all filters is the price to Morningstar fair value ratio. So that's going to be right here. So that is a ratio of what is the stock trading at to what does Morningstar think that stock is worth per share. And I'll show you this a little bit more. But you want to have a ratio less than 1. You want the current stock price to be less than what Morningstar thinks it is. So I'm going to put a value here, and really nice graphic they'll show you. The top quartile of performing stocks have a Morningstar price to fair value ratio of 0.37 to 0.91. They're undervalued stocks. So I put 0.7 here. It's quite arbitrary, but um, that's the number I use just because it gets down to a manageable number of stocks I can look at. And then the last thing I do, and I'm not sure that this is entirely necessary, but I like to do last closing price. So I want to do stocks that are greater than equal to 15 cents, and I have some friends and people I talk to every day that trade stocks that are 2 cents, and they do really well. But in my experience, when you're trying to filter through these stocks and find quality companies that aren't having immediate threat of bankruptcy, uh, by putting in 10 or 15 cents or even 20 cents, you can get your number of stocks down to a reasonable number to peruse. And I think it kind of removes some of the headache of trying to pick out some of these stocks that are literally down to a penny or two. And that may be because they're going bankrupt and we want to find some quality companies. So after that, we're going to go ahead and click button to view results. And we get this awesome spreadsheet here. The first thing I do is change view from snapshot to Morningstar rating, because that's going to give me what I think is the most critical column, and that's this right here, price to fair value. So I'm going to click that, and we're going to get our list of stocks in order of how undervalued Morningstar feels they are relatively. So today I was running these filters, and I actually bought a little of this Brickell Biotech. So once I get to this point, I'll click the company, And this company, Brickell Biotech, the ticker is BBI. And you get this thermometer looking graphic here. And Morningstar will tell you they think this stock is worth $2.22, but the last closing price was $1.10. So they think that you're buying this stock at a 50% discount. It's a lot easier to make money on a stock that is presumably undervalued than something that's overvalued like Apple, or at least in the mind Morningstar, Apple or Tesla. So the way I feel these micro caps provide two advantages is a lot of them are extremely undervalued. The market's been cruel to them. Either a lot of people are shorting the stock, which I can explain in another video if people end up interested in this. Um, but the market is cruel to these little companies. And so they manipulate these stocks to where they're extremely undervalued. So you're paying, half price for these stocks, and they're also very small, so they have so much more room to grow their value versus a company like Apple that's worth, $2.17 trillion. You're finding companies that are worth $50 million or less, uh, or $100 million or less, or $1 billion or less, and you're going to buy these companies that are already undervalued, that have extremely low valuations and ability to grow extremely fast. And to me, that makes incredible opportunity to make a lot of money relative to your investment. All right, so I just had a little cutout, but the way that I kind of pick out which of these stocks I'm interested in buying is I start with these filters, and I start by sorting out what does Morningstar think is cheapest, and then just a few at a time, I'll usually you go into a Yahoo Finance app and I type in the company name or clicker on my phone and I kind of read. It's a great app. They have lots of news articles, and they'll kind of tell you about what's been going on with the company. Another great app called Stock Twits, which has some it has some lousy commentary in it, but also has some really good-hearted investors that are trying to help people out, kind of sharing information as I'm trying to do. And I buy these companies when they're undervalued, and I think that they've got a good product, and apply the knowledge in my field of medicine, and people can do the same. I was talking to some of my buddies in IT and telling them, you guys can do the exact same thing with some of these early technology companies, and don't be afraid. You have a metric here that's telling you this company is it's too cheap, and you have some sort of training or job experience or life experience or hobby interest where you know a lot about a subject. And if you stick into that subject matter or sector and apply what you know, and you can see some companies that just have unbelievable products and unbelievable potential, and you can see that they're going to grow. And I've had tremendous success relative to S&P 500. I've helped a lot of people out with as little as a few $100s to start trading stocks with, or I talk to some people that have multiple millions that they can invest. And everybody that I've done this with has had a ton of success, and I've learned a ton from people uh, that bring something completely different perspective to the table. A lot of people are super afraid to buy into these small companies and are under the impression that these penny stocks are a scam or that you're going to lose your money. But they're a tremendous opportunity. They do have some volatility to them, and again, I can make some more videos, kind of showing how I attack some of the more volatile companies, and some options you have after your stocks have done well. So if there's any interest out there, let me know. I'd be happy to make some more videos. Hope you enjoyed.